valuations of tech stocks today?
From 2010 until today, the PE has averaged over 60% higher than it did for the prior 100 years. Now, I don't know when you decide to say the market is overvalued, but if you're traveling at 60% higher PE than it used to be, I think that it doesn't say the market's going to collapse, but it does indicate it's expensive.
Well, it is going to collapse, and it's terribly expensive. And if you extrapolate, that's probably about a 70%, 60, 70% crash. So this whole thing with all started with free money. That's why tech's overvalued. That's why tech's insane. I mean, think about the years, 2008, 2022. QE. What they do? They print money, Treasury printed money. Then they went in, they bought Treasury, dropped those yields down, keep dropping those yields down. I mean, QE was nothing but a sham. Zero interest? What are you, nuts? And it's like when you give a person, you work hard, you own an apartment house, and it's beautiful, and you really worked hard to make it nice for somebody, and you rent it to somebody that, let's say, is an old buddy of yours. Oh, I'll put you in there for 3-4 months, don't worry about it, the rent, I usually charge $2,000 a month, I'll give it to you for $500. What do you think that unit's going to look like at the end? It's going to be destroyed. That's why, like, all these housing projects they do, these government federal housing projects, you know, now that we got the communists taking over the Democratic Party, they'll probably start again. Why are they always, these beautiful projects, they start out, have an opening day, and then they're just slums? Because it's the same thing with tech, but tech is not a slum. Tech is being destroyed with PE ratios. And when money is free, investors stop caring. You know, the old saying, how much is the interest rate at the bank? You're getting a loan? Yeah. How much is it? I don't care. It doesn't matter to me. Okay, I don't care. If they're dumb enough to give me the money, I'll take it. And when interest rates are low, that's what happens. Investors don't care about price. And they chase growth. And once you start chasing growth, where do you go? The only place to chase growth is tech. Everybody piles into the same 12 stocks. I mean, right now, think where money goes. Money's going into the 4 stocks that are driving this whole market, if you will. You're talking about the machines that make the chips. There's 4 companies that makes these chip machines, and they've gone nuts. And everybody piled into those. And so, I mean, they're just enormously overvalued. And in fact, remember, tech stocks to rally, they like low rates. But even when rates were rallying, going up, people were still piling in. They didn't care about the rates. Remember, tech stocks want low rates. It's just like banks needs high rates. But nobody cared. Rates were going up. I mean, look at the 2-year Treasury. Over 4%, you got to keep that 2-year yield about 3.25, 3.50. It's way over. It's when you get above 4, it's a death trap. And so, and then the 10-year kept going up. And then you looked at these 4 stocks, and it kept going up, every day. Here, let me just see if I can explain it to you here. Maybe I can get this chart working. So if you look at the 4 stocks that drives the entire market, stock market, and nobody even looks at trend anymore. I'll explain that in a moment, but let me get this up here and get the charts for you here, just to show you. Okay, so let's take a look at the chip stocks, or tech stocks, and the ones we want to look at first, okay, are the machine makers. So let's take ASML, okay? And when that stock kept going up and up and up and up, it needs to go up on low yields. But it was going up on high yields. Nobody cared, right? So, and the trend just kept going and going. Then all of a sudden we got a little bit of hiccup the other day, right? Because yields now, people are starting to say, wait a minute, these yields are a little too high, right? So again, and you look at LRCX, AMAT, CLAC, those trends have gone up for the wrong reasons. They're going up because yields are high. You don't want to be investing long term, okay, in tech stocks when yields are high, because that's a trap. And it's going to come back on you, okay? At some point, it will. Now, you may get away with it for a month, 2 months, maybe even a year. Just like what happened in 2008 to 2012 with zero interest rates. So everybody piles into tech. Everybody's piling into those stocks. And now we're seeing people piling out of tech, and they're piling into leisure stocks. Now, leisure stocks do well when yields are going down. And if you looked at the yields this week, and I'm going to show you, just take the 10-year yield. Okay, we'll take the 10-year yield, take the 5 days. Look at this. Look how that collapsed. It collapsed. Look at that. We're right just at 4. That's the 2-year yield. We're right at 4. And what a drop that had. And then, so you got, now the yields are starting to drop, right? And so with oil dropping, yields dropping, everybody's switching over to leisure stocks, because, especially airlines, because when oil's down, jet fuel is down. And of course, when yields start going down, right, people will start traveling more. They get, they can borrow money a little less interest rates. But take a look at this other one, the 10-year Treasury. Look how that collapsed this week. That's nuts. So going back to this reason, the reason they chase these same tech stocks, because they pay very little for this money. That's what they're doing. And they would pay anything for future earnings. So, I mean, think about this push tech valuations so far above the normal. It's insane. Cheap money equals expensive tech. And you got your tech machines, you got the companies who buy the tech machines. As I said, there's about 12 companies. Those are going to explode at some point when they keep climbing, when yields keep going up. They just happen to be lucky right now, yields have dropped. But that's going to change, because remember what drove the yields down? Oil. Oil's driving everything. And they already blew up, a ship last night? Does anybody in their right mind really think that Iran, those monsters, okay, who put babies in microwaves, you're going to make a deal with them? I've been saying this all along. So oil came down. That's great, but it came down for the wrong reasons. So when oil came down for the wrong reason, you have the stocks moving back up. Oh, oil's coming down. No, it's a trap. So once again, this whole thing with the Fed, when they made this money free for really about 15 years. Investors just stopped caring about price. They just chase growth, and they pile into tech to chase growth. And they pay anything for future earnings. Money was cheap. This pushed all the valuations crazy, way above norm. And then the tech became the only game in town. 12 stocks, the only game in town. And while the rest of the economy was starting to slow. Banks were slowing. What was the other one slowing? Energy was dead. Energy was going up for the wrong reasons. Now energies are coming down for the wrong reason. I mean, this whole thing with energy coming down started this whole explosion with the 10-year and the 2-year coming down, and people jumping into these stocks because the 10 and 2-year are down, and that means, hey, great, I'm going to buy more tech. Really, it's not working out very well, is it? And the people who are in those 12 stocks, now I'm talking about the machine-making stocks, those 4, and then the people who buy those machines, like Intel and so forth, and Micron Technology. One day, you're going to get caught in those. Now, tech was the only sector, think about it, growing double digits. So all the money was flowing into about, 6 stocks. You had Apple, Microsoft, Amazon, Google, what else was there? NVIDIA, Tesla. That's it. So they became the Magnificent Seven. We call them mega stocks. And so everybody bought the Magnificent Seven. And everybody just, again, jumped in by an index. This is crazy what's going on. So we're going to see at some point that all this AI hype, okay, this pouring gasoline into the fire and all this, especially from 2023 to 2024, the hype is just terrible. I mean, look at NVIDIA. We're shorting NVIDIA right now. Microsoft, right? Same ones. Meta, Amazon, same ones. So suddenly, every dollar in the world was chasing those stocks. So when we see that yields are now coming down, and here's the interesting thing. When you see yields coming down and you're not seeing these stocks rallying as much as they should be, that's a warning. So when you go and take a look at, let's see if we can catch up to let's take a look at Amazon. And everybody's asking, well, wait a minute, if these yields are going down, the 2 years going down, the 10 years going down, what the hell's going on with my Amazon? What's going on with NVIDIA? We're short these. And you got people chasing them and buying on the dip, which you never should buy on the dip unless there's QE, but they're buying on the dip on the way down because the reason why they're falling instead of going up, everybody's asking me, why are these tech stocks going down? When the 2 year is going down and the 10 year is going down, shouldn't they be going up? Yes. But they're not going down enough. The longer you keep that 2 year treasury above 4, it kills these techs. It will cause a collapse in these techs. So let me just say this, that this whole tech thing is so overvalued, it's insane. But all you have to do to stay safe, you got to know how to go long, and you got to know how to short stocks, number 1. 2, don't follow the noise. Follow the trend, the money trend. Follow the money trail. The whole world, what do you do? What are you taught? When you first get into it, follow the money, follow the money. The police, first thing, follow the money. Everything's follow the money. It's the same thing when you're trading, follow the money. And you can tell when the big institutions are putting money into the tech stocks or taking money out, it will tell you. You have a trend. And then not only that trend, you have volume that will tell you. You can always tell. And then you always know when the market's going to crash. As I told you yesterday, think about it. We had 4 crashes in the last 25 years. And the signal has never let us down. The signal that Wall Street doesn't want you to know about. The signal has never been wrong. The last 4 crashes, during the dot-com, the housing con, the COVID, and the, what's the last one? The Fed bear, we call it, the bear trade. All those crashes, they were pointed out well before they occurred. And again, you don't have to guess because you'll see that 3 year break below the 2 year. I mean, think about it. 4 crashes we've had, dot-com, you know what they are, dot-com and housing con and COVID and I forgot what the name was, the one in 2022, I think it was. That was the one, the Fed. They created this stupid bear market. Anyways, that's when they started to raise rates. So those collapse. I mean, you're talking 40%, 57%, 38%, 22 or 27%. Never was that indicator wrong. So please watch your 2 year and your 10 year to decide when to get in and out of stocks, and make sure you watch the 3 year. If it goes underneath the 2 year, it's always been right. It always forecasts correctly a correction or crash. So who caused all this? Again, the Fed. They're stupid. The Fed's never done anything right. Never do they do anything right. They got a bunch of dummies in there. And they cause these overvaluations, and they're going to cause the biggest crash in history. They caused that. And the biggest cause, as I said, was when they did free money from 2008 to 2012. Somebody's got to pay for that. All right, that's about it. So have a great weekend, and we'll pick this up again on Monday. See you on the charts. Enjoy your day.
Are you nuts?